Du lytter til MA 360, podcasten for dig, der kraftigt overvejer at sælge din virksomhed, men ikke helt ved, hvordan du skal starte. Mit navn er Bettina Nygaard, og jeg har som CEO og ejerleder været igennem salgsprocessen hele 2 gange med softwarevirksomheden Scanmark. Og jeg ser det som min mission at give dig svar på de spørgsmål, der vil klæde dig bedst muligt på til at sælge din virksomhed. Tusind tak, fordi du lytter med, og rigtig god fornøjelse med episoden. Today I'm pretty excited because I have received a lot of questions from the audience about what is the difference between angel investors, seed investors, venture capital, private equity, etc. So today I have Henrik Aspen, partner in Verdane, with me. Henrik, you have a lot of experience within this area. You've been in private equity for more than 20 years now. And I think that you are probably the most suitable person for me to ask that question. Can you help us, me and my audience, understand what hides behind these terms?
Yes, it's very much about what kind of phase is the company where we invest in. How mature is it? How large is it? So speaking from the beginning, it's like seed investments are actually companies with no revenue whatsoever. It's more like an idea or something they would like to launch. And then, of course, that company develops, and then you go getting some sort of revenues. You're into early stage investments. And then when the company actually gets more and more like revenues, still perhaps loss-making, we're talking about like venture capital investments. So still, I would say, a high risk, but a very high reward. And then move into growth equity, where most companies are either break even or could be profitable. And then at the end, with the largest, most mature company, we do have private equity. And that is company that can be extremely large and profitable, where the, to say, large P investors are.
So angel and seed, is that the same?
I would say angel are more private money coming from private persons, most likely called like business angels, right. If you relate to that. And then on the other hand, you have more established firms, which we would call institutional capital. So I would say angel are most likely angel investors in early phases.
So when they start making money, then that is when they're going to be called venture or growth, right?
Yes.
Right. But Henrik, before I talk about what Verdane is looking for when selecting interesting companies to acquire, I thought that with your more than 20 years in the business, perhaps you can explain a little bit about where is it exactly private equity comes in and finds an investment interesting. That is when the company is up and running and makes money. But is it only because they're profitable, or is it something else that defines this borderline?
I think it very much depends on who is actually making the investment. We are a growth firm, so we would like to invest in profitable company, but we can also invest what we call structural profitable companies. That is companies that are perhaps not profitable bottom line, but they have like a core business which are profitable. And then they are investing either in new markets or new products, which then makes the overall company not profitable.
Thank you for that explanation. So, given what we know now, where on the scale do you then place Verdane?
Yeah, no, the short answer is that we are a growth equity firm, and the bit more longer answer is that we are a European growth investor that focus on businesses supported by the digitalization as well as the decarbonization megatrends. We invest with the purpose of creating a growth for a better future, and our mission is to be the preferred growth partner to ambitious companies that will try to make them a bit more sustainable. Our funds invest in tech-enabled growth companies headquartered in Europe.
So is it in the entire Europe, or is there some areas of Europe that are stronger than others?
We have started from the Nordics. The company was founded 20 years ago in Norway, and we sometimes refer to what we call the beer drinking part of Europe. So we invest in the Nordics, in the German speaking part, Benelux and the UK.
That's a very good strategy. The beer drinking areas. That's something people can understand.
Yeah, I think they can relate to it. And of course, many countries would argue that they, of course, have much more than beer. But at least we're not investing, so say, south of the Alps currently. We would occasionally do it, but we feel more comfortable in doing it where we do have local presence on the ground.
So what sort of partner would you get if you get Verdane in as an investor? How can you describe yourselves and the value that you add for the companies that you invest in?
We try to be the preferred growth partner and really helping our companies to grow. And given that you have been a CEO yourself of one of our portfolio companies, I think you can relate to that as well. So we try to be close to the founder, close to management, and be supportive and to really help the company fulfill their, so say, ungrown potential or to really prosper as a firm.
Yeah, that was at least what I saw, because when you are a founder and you are working as a CEO in a business and you are selling it to a PE, there are a lot of myths out there, and you tend to be a little bit anxious and afraid because as a CEO you're pretty. I was a bit nervous that I was going to live my life in a spreadsheet and be only reporting and not doing real value for the business. But I can say definitely that when you guys came in and as the new owners of our company, of Scan Market, that was not at all how it was. Actually, I found it really interesting to be part of something where I had access to a very deep knowledge base in terms of people, smart people that could help me where I was perhaps not the best person suited for solving those problems. So I'm actually pretty happy that those myths were put to shame. Can you tell me about what sort of companies that you are interested in? And here I mean, are there anything out of growth that you are looking for?
I would say yes. As a growth equity investor or structural growth chaser, as we sometimes call it, or we like to call ourselves, we work with businesses that fulfill, I would say, 5 criteria. First of all, they operate in a structural growth market.
What does that mean, structural?
Not cyclical, so really like long-term structural. So it's not like we are in an economic cycle where people are spending more. It could be a shift from offline to online, could be migration in from, so say, perpetual license to SaaS businesses, to on-prem to cloud-based businesses, to really what are the long-term structural growth trends.
Understood, yes.
And also we would like to see is a proven strong customer love and a high gross revenue retention. A robust value capture with a sustainable competitive moat. Ideally, self-finance growth, i.e. the company can finance its growth by the running cash flow. And of course, identifiable opportunities for non-organic growth, i.e. buy and build to acquire more companies, or merge and acquisition, M&A also called in the PE industry.
So are there companies that you'd say that you're definitely not interested in buying?
Yes, I think definitely with ours to say that are cyclical, or companies that are asset-heavy businesses with limited scalability, and where I think at the end of the day where we feel there's not a good cultural fit.
How do you know if it's not a good cultural fit?
I mean, first of all, we try to interact with companies for several years before actually investing into a company. And you actually realize quite fast if you're out on like dating somebody, after a few times you realize, is this a good fit or not? So we try to avoid being in situations where we need to make up our mind if we haven't met the founders before.
So you actually start connecting to those founders years before you even enter into a partnership?
Ideally, yes. It depends on, of course, given the situation and the opportunity to meet. But that definitely we would like to do, because we would like to avoid like forced marriages. That's not, I think, a happy end for none of the parties involved.
No, so true. Are you looking at management in the company? Is it important to you that the management team is of a certain level, or are you educating management?
I think first of all, part of evaluating a company is very much about who is in the driving seat. Do they know what to do? Do they have like a grit? Do they really know what it takes to evolve the company going forward? So first of all, we need to see that there are some sort of basic fundamentals there in place, that we are aligning with the founders on what to build. And then of course, then we can strengthen the founders with even more profiles that are complementary to the existing founders. But we would not invest in a company if we don't have the trust, or if we doesn't feel that these are the one that will take this company from A to B.
Makes sense. Do you, when you look at a company, how do you then figure out what to pay for it? How do you calculate the valuation of a particular company that you're looking at?
I mean, first of all, it's on a very case-by-case basis. So I would say each company has its own criteria and its own merits. But at the end of the day, the companies are bought on scalability and profitability, and of course the strategic position they have. So I think you can elaborate quite much about that. So looking at software and digital consumer businesses, since you used to work at a software firm, Scan Market, we can chat a little about software valuations. So market sentiment affects both private and public valuations. So relevant comp set, which is short for comparison or comparables, is a starting point for all valuations. So also private
listed companies that are in the same business.
Listed companies actually follow or actually dictate, I would say, what you would be or partially paying for a company which is private. SaaS valuations correlate to a high degree.
Software as a service.
Software as a service valuations correlates to a high degree what we call the rule of 40. And the higher the number, when you combine the average growth and the EBITDA margin, the more likely a SaaS business is to higher valuation.
So that's interesting, because the rule of 40, could you explain to the listeners exactly what that means?
Yeah, it's actually by combining two parameters. First, how much is the company growing in percentage? And then you also add what's the EBITDA margin in the business.
So how good are they at growing? And then hold it up against how good are they at making money?
Yeah.
Is
so
that correct?
let me give you two examples.
Yeah.
One company is growing amazingly with like 100%, but they're also having a negative EBITDA margin of 30.
Because they're investing and they're trying to grow.
They're investing heavily. So of course that combination with 100 and then you plus minus 30, you would be at actually 70.
Right.
Now you have a company perhaps growing at 50%, but with an EBITDA margin of 30%. Then that's a rule of 80. And
Understood.
looking to our existing portfolio, many companies are around between 30 and 50. It's quite rare and seldom that you can find companies that are continuously delivering above 50%.
Yeah, because it's getting harder and harder to grow at the same percentage, right?
Given the company becoming larger and larger,
Yeah,
of course, that is more
yeah.
trickier story. Yes.
So the rule of 40, as you call it, is that something that's only typical for Verdane, or is it something that the industry is?
No, I think it is very, very common in, to say, especially in the software investment industry. But of course, there are other also relevant, what we call KPI, key performance indicators. If you add also to the rule of 40, it's first of all the ARR growth, the annual recurring revenue growth. How much is actually the subscription base growing, and what is the percentage of recurring revenue of the total revenue.
So you find recurring revenue more interesting than if I'm good at selling my billing hours or
Yes, because the recurring revenues there will also be there tomorrow and the day after tomorrow.
Yeah.
In your example, you need to sell that every day. You wake up every morning with a zero in revenue. But if you have a high proportion of recurring revenue, you will have that tomorrow and the day after tomorrow.
So what you're saying is that if you are selling, for instance, subscription-based software,
Yes.
then you find it a lot more interesting than if a software company is really good at selling development, for instance, develop new software for others, because that would be hours that
Yes.
you're billing here.
And
Is
then-
there a huge difference there?
I think selling hours, you don't have the scalability. And
True.
once the people go home, and once they're not billing, you will not get any revenues. So of course, having a recurring revenue with a very high, so say, net retention rate with a low churn is an ideal for all companies.
Can you explain what churn is?
Churn is, of course, if you are having customer that are actually then stopping buying your service, you would have like a churn.
Okay, so it's a customer that I'm losing.
Customer losing is churn. And you can actually, the more you fill in with new customers, of course, you will also want to be sure that you're not losing customers at the end of the day. So not customers that are stop using your service.
And retention is, of course, then how good is it? How good are you at retaining this revenue? That
and
you
of course, with selling there more products and so forth, ideally what we call, so say, net retention revenue, being able to actually increase the revenue from each customer by selling, so say, more products to the existing customer.
That's very interesting. So I think that a lot of our listeners, they don't know exactly how a private equity company operates. So can you perhaps try to help us understand what hides behind this? So you have people investing in your funds. How does that work? They make a promise to you that they would sometime over X years actually have money which you can then call. And then when you find another company to invest in, you would say, okay, I found a good company. Now you promised me 100,000. Now I need to spend 20,000 of your money, on this particular company. Is this how it works?
It's correct if you describe how we as Verdane working, since we are collecting capital into our funds from, so say, large institutional investors that commits a certain amount of capital, which we then later on can what we call on when we have identified the interesting companies. Some other structures, if you have like an evergreen structure, you have the capital already available. And
so
then,
do they on day number one pay in the 100,000 if that's what we're talking about?
So some sort of foundations or other like evergreen structures, they have the capital available, and then when they make investments, they can actually utilize that capital.
But that's not how you operate.
Now we have a fund structure where you said we go first to the investors, ask them to commit capital, and then they put the trust in us to help identify the best type of investments. And once we have identified a company, we call capital. They deliver what they have agreed upon. We invest into the company. We are doing our utmost over time to make these companies or the money grow over time. And then at the end of the day, making an exit and being able to deliver back money to our investors.
How long is that time period? I mean, don't they go out? Don't you risk that they go out and spend that money? I mean, if they say today that you can have 100,000, but I'm not going to pay you 100,000 today. What if you come then 4 years later and then say, so now I would like you to deliver on your promise? Don't you risk that they spend it?
I think we are approaching really long-term investors. Like the governmental or pension funds, which have a very, very long ownership horizon when they're looking into money. So this is a very illiquid asset class. Comparing if you would buy a stock over the stock exchange, then you can actually sell it tomorrow or today, given where you are on the day. So this is really, really long-term capital. It's very illiquid. So, and our average for, so say, investing and then making exits are roughly 5 years.
Okay, so that's your average ownership period.
For the single companies. But then if you take it into a fund, our funds are 10 years plus.
Okay.
So if you commit capital to our funds, you need to see, okay, this capital will be illiquid for at least 10 years.
Understood. Because are you then calling all the funds within the first 5 years, or are you leaving something, to add on acquisitions, or how do you operate in terms of that?
Our standard procedure is to have a fund which is roughly 10 years long, and then with the investment period, i.e. we make new investments during the first 4 years. And then, of course, we also allocate a buffer for follow-on investment into the certain assets we do have in the portfolio.
So the investors that you have, do they tell you, hey, we don't want you to invest in this and that, or we want you to focus on this and that? Do they dictate what you buy, or are you actually framing it from the beginning when you're trying to attract capital and tell people we are investing in these types of companies? How do you do that?
I think all funds and firms have their investment criteria. What is a typical Verdane deal? What is a typical deal we would like to invest in? And these are the type of companies you would expect us to invest in. And of course, we also have prohibition to not invest in arms or weapon or tobacco, alcohol. So they know some cases what we will not do whatsoever. But if we're ending up in a software company within supply chain or pricing optimization, it's nothing our investors knows in forehand.
Do you feel there's a lot of talk about ESG, and I feel you see it more and more, it's getting more and more powerful. Do you see a push from your investors to actually go more targeted after companies that can document or at least have a footprint, a strong footprint in terms of a good ESG rating?
I think it has definitely been much more up on the agenda. We have what we call the 2040 rule, which goes for all our investments. And that's simply speaking, once we have found an interesting growth company supported by either or both of the digitalization or the decarbonization megatrends, we ask ourselves, does this company fit into a sustainable future? Will this company actually still exist in the year of 2040 when you need to pay for carbon offsets, you need to really take care of your products, what we call the 2040 test. So if the company is not passing that filter, we would not invest.
Okay, that's an interesting angle. What, when you are deciding to invest, I know you have an investment committee, and all PEs do. But can you explain the dynamics of how is this investment committee put together, and who decides, who has the final say in what you're going to invest in? Can you maybe take us through the process of the decision making?
Yeah, we have different kind of decision gates. First of all is a deal team or people working with trying to make an investments. They make the first, decision by themselves. Is this a deal we would like to do? Is this like a high conviction deal? And then we have different clusters. We are organized according to sectors. So we do have, 4 software clusters. We have 2 consumer clusters. We have 2 within sustainability. And then depending on where this company belongs sector-wise, we have people only working with those kind of sector, i.e. cluster, and then making, a decision if we should spend more time investing a potential investments or not. And then later on, once we see there is actually a deal that can be done here, we are preparing material internally and are also asking to spend even more internal resources, and then also being able to spend external capital money into DD resources. And DD stands for due diligence, which is actually then going through the entire company that we would like to invest in.
So these investment committees, are they only Verdane people that are members here, or is it also industry experts that are part of those committees?
We have it only internal. And I think depending on the sector and the size, we'd have different compositions. We have our chief investment officer. He is part of all the investment decisions to get to say some sort of being able to make the same kind of decisions depending on the sector. And then depending on what kind of sector we are making an investment in, we have sector expertise, and we also have people responsible for the fund investing as part of the decision body.
So now you have decided that you want to approach a company. You have been looking at the company, following it for a long time. So what factors are then important for you in your valuation? I mean, there's something that you need to present to your investment committee. What is that you need to put forward to this committee before they even let you go to the due diligence phase?
Yeah, I think it's very much about understanding the company. So I would say, first of all, it's about the offering. And when I'm saying offering, it's to say information that we get from the company that help us understand the offering. What's the value proposition? What's the value capture model? What are you as a firm offering, and how are you offering it? For which customers, which groups, and why is this relevant? So how is it different from the other alternatives or competitors' offerings? To really, what is standing out with your offering?
Isn't it difficult for you to get some sort of to get an understanding of a company on such a short time? Because it's not a long time actually you have for that, is it?
No, but given that we have been doing investments for the last 20 years and have been carried out more than 400 growth investments, we have, so to say, sorting or gathering a lot of underlying data from all the companies. So we're starting to get more and more information of the underlying sector. What is a relationship? What is a conversion? What is the efficiency in R&D development? What is the onboarding process? What is really making a company efficient? How are they, so say, trading according to our benchmarks? Are they above? Are they below? So of course, that kind of data we gather for several years. So, I mean, I mentioned about the offering, but it's also understanding your customers. I mean, the firm we are interesting to invest in, what's about the comfort info that help us understand the customer base. Who are they? And what do you think about your company and your offering? Do they have, so to say, EMPS, different kind of measurement? What are the complaints? We talked about churn before. That's some sort of good sign. If you're having a low churn, that people are actually loyal, they are sticking to your offering and not, to say, moving to other competitors.
I think that's one of the things that for me that I thought was really impressive, because my company produced e-sourcing software, and I don't think that very many of our listeners out there actually know what e-sourcing is. It's quite a niche area. So that you came in and actually understood how we helped our customers, what was the value. It was pretty impressive because we had not spent all that much time together, and it is a niche area. So I think that the ability to on a higher level actually be able to see through the real message in the company was extremely impressive, I have to say. So I thought it would be relevant to ask, what's your secret? How do you do that?
I think, first of all, we try to be extremely prepared. Mm-hmm. We try to really understand the underlying sector. What are the trends in the sector? Because we know if there's a trend ongoing, we need to understand how that will affect the existing companies there. So the more information we can gather, the more we also can interact with competitors, with suppliers, with customers, to really get like a 360 view of you as a company. So the more we can do before, the better.
So can you tell us about if there are deals that you are walking away from?
Yes, definitely. I mean, we are walking away from discussions every now and then. Sometimes it is a company that that we really, really like, but we can't align on the valuation between...
Because their expectations are much higher.
Because we as a buyer has one sort of how we view valuation, and then the existing owner has another view. But I mean, it's more things where there are evidence or indications of like poor behavior, mismanagement, or similar. It could be a poor promoter score from employees, from customer partners, or other stakeholders. Could actually be actual data that material deviates from what you have communicated earlier. I think also could be that we do have a lack of alignment on what kind of company would we like to build, what is the ownership agenda, how are we going to work together. So
the advice from your end would be to owners wanting to sell their company would be actually take out your dirty laundry and let us know what's there so that we don't get disappointed during the process.
And I think also be transparent.
Yeah.
Because to say, okay, we have done some historical mistakes. We're fully aware of that. But I think you should not try to hide away former mistakes, because they will be public.
Yeah.
It's just a matter of time.
So when you need a material from a company in order to be able to consider if you're interested in engaging on further conversations, what is it that you're asking for? What do you want them to supply to you so that you could actually get this understanding?
I think it's very much about to understand, as I mentioned before, what are the companies offering? What's the customer base? How are they actually performing? What's the view from the customer? And that is, of course, gathered by a lot of the financial data, but also looking on the promoter scores, on the loyalty of the customer base. And of course, what we also would like to get a more understanding is about the team, who is actually running the business, management and organization. And of course, what is how have they performed? Do they had access to historical financial data? And what is the business plan and the projections for the future? And are they reliable? Have they been done on a more bottom-up model, or have they been more...
What's the bottom-up model?
Bottom-up model. For instance, if you say that we would like to grow this company from where we are today to this amount 3 years down the road, it needs to be built up. Okay, we want to grow the company with 50%. How is that going to be delivered? Yeah, we will actually expand our existing product range with these and these features. We will also expand our activity into this country. So you actually can see and follow how many customers will be added, how have they calculated people or customers leaving churn, and do they have like a model which we actually believe in? And is there also like structural growth trend supporting the company's forecasts?
So what you're saying is that you not only would you like to have the number that they plan to reach in a few years, but you would also like to know, well, how exactly are you going to execute on those numbers? How are you going to get there? What are they?
It doesn't need to be exactly, but it needs to be a story that we believe in, a story that we buy, that we would like to grow our company from where we are today to this, and it will be done with X, Y, Z.
So when you then get to the due diligence phase, can you describe how you are performing due diligence on a company?
Yes, in the beginning, there's the sourcing of the prospective investee companies. First of all, to really identify the company with all what that entails. Sometimes there are years between the first contact and an actual investment because the conditions needs to be right on both sides. And once there is an interest in investments on both sides, as you mentioned, we start to loop in our Elevate team, which is our in-house operational team, for a quick and broad assessment that's actually distilled into what we called a DQM, a Deal Qualification Memorandum. Essentially, our Elevate team allows us to be time, cost, and resource efficient in this stage because they work very closely with our investment team. They have a full understanding of all the internal processes and information that can flow freely within the team. It makes it easier to get to where we are answering the right questions quicker for the investment team.
When you mentioned before that you were evaluating the people and how satisfied the employees are and so on. How do you do that? Because you're not allowed to talk to the employees yet, are you?
No, but I think more and more companies are actually performing, so to say, EMPS or different kind of promoter scores. And of course, we try to see if we can get access to those kind of data services. And then, of course, we can compare that with our own existing portfolio.
So if you look at the score, what would you say, okay, no, now it is too low. Now we're not engaging because people are not happy here. Where is it that you...
I think, first of all, that's only like one data point from several. If there's a low promoter score, I think we need to understand why is that the case. Has the company mismanaged? Have they changed CEOs? Have they changed, say, a C-level into one of the department recently? Or why is the reason? So I think, first of all, one is to get the score. And then second is, of course, trying to understand why is it high or why is it low.
In your due diligence phase, then it's a pretty, I understand, expensive exercise to do due diligence on a company. So I assume you don't do it just for the fun of it. You actually mean business. You are seriously interested in buying a company when you enter into a due diligence. Do you do it with with the Elevate team only, or do you also engage, experts, to third parties to help you do this due diligence?
Yes, definitely. I think we can get a lot of help from our Elevate team because they are really specialists in the type of companies we are investing in. But we're also working with external parties, especially when it comes to legal and financial. And if we don't really understand the underlying market well enough, or if we don't have enough of data points of the underlying market, we're also working with, so say, market study and market mapping to really understand the underlying market. And that is partially done in-house and partially done, so say, with external suppliers.
Okay, interesting. So now the due diligence is done, but do you know why do owners actually choose you as their new owner?
I think it's like a mutual evaluation process. When we are making our DD, the companies are also evaluating us as an owner. And I think, first of all, we are specialists. We have been investing in growth businesses for the last 20 years. And our fund performance is, I would say, exceptional in both absolute and relative terms, which mean that we have been able to develop the companies according to what we thought or said at the time of the investments. We are also local. In our experience, it makes a difference to founders and management teams not to have to board a plane to meet your investors or to be in a different time zone. I think it's also very useful if the same investor has local teams in many of the key markets where your business wants to launch or grow, which we do have with local offices all around Europe. We have also done a lot of investments in the space. First of all, we have been able to know how to make successes, but we also make inevitable mistakes continuously, and we try to learn from them. So I think bringing on a experienced investor is that we will not make the same mistake twice.
I think that I can add maybe a little bit to this, because when we ran our process and we selected Verdane as our new owner, Verdane was actually not the highest bidder in our process. But even so, we preferred to go with Verdane because of different factors. Because we felt that there was a great cultural fit, because you had actually understood the market that we were in really, really well. This is also why I asked you before, how do you do that? Because it was not an easy market to explain to people. And we couldn't see the same understanding from the other parties involved in the process. And then also because we had an idea of you being able to lift us to the next level because you had access to these very smart people who actually could help us out where we were weak. So just to let you know why we selected Verdane back then as our new owner, and we were not disappointed, I can tell you that.
That's great to hear.
So during the ownership period, what sort of reporting, what sort of information do you need back from management? Because I was pretty scared that I had to do reporting all the time, and that was not at all the case. I actually met a very good understanding from the Verdane team that it was business first and reporting after. But you do need numbers. You do need somehow to keep track on your investments. So what are you asking your portfolio companies to bring back to you as information?
Yeah. I mean, first of all, I think during the DD phase, we are asking for a lot of information to understand the business. But once we have done the investment, we try to be, so to say, as efficient as possible, as you said, not being our companies spending too much on reporting. So I would say it's very much about standard profit and loss statement. It's also different kind of KPIs, so key performance indicators, as you can say, of revenue growth, of churn, different KPI that we are aligning with you as a founder to be reported on a monthly basis. And really what we're actually saying, ideally, these are reports that the CEO and the companies should produce
anyway
for the management team. And then I'm saying that is the information we would like to have as well.
So after closing, can you explain what happens then? Do you select new board members? Do you want to be present on the board yourself? Or what happens after they hand over the keys to you?
Yeah. I mean, first of all, before actually signing the deal, we are securing that we do have an alignment of what we are building, an alignment of the future plan, which we then capture in the ownership agenda, which is done actually before signing the deal. And then once the deal is signed, we try to share all our DD findings. We bring in our ops team, Elevate, that actually can present what they have identified in the business.
Things, to the owners.
To the owner. Things that are good, things that need improvement and that needs to be taken action. And then we sort of gather all the actions that we would like to do in what we call like a 100-day plan. And that are things that should be ideally action and delivered within the 100-day plan in order to get a kickstart of the ownership period. Therefore, we are looking into the management team. Do we need to strengthen the management team? Ideally, we would have to identify that during DD, so we actually can quite fast initiate a recruitment and then fulfill their positions. We're always trying to...
Do you help do that? Or?
Yes, we do have an in-house recruitment team within Verdane Elevate.
Because some of this very time-consuming things for a middle-sized business is actually finding those smart people.
It's very time-consuming, time-consuming. And then we're also, of course, to say, how can we position a board in an efficient way? What are the strengths and weaknesses for the existing management? And what kind of profile do we want to have on the board? And then, of course, choosing a chairman is extremely important. And ideally, we would like to have an independent chairman. So, i.e., not someone from Verdane, to really a person that knows the underlying industry, that can support and be a sparring partner to the CEO. And then we would like to be, as I say, representative on the board, but ideally we would like to have a small board and also board with independent experts really understanding the underlying sector and market that can add a lot of value to the CEO and the rest of the management team.
Do you select the board members together with the management team, or do you do that yourself, or how does that work?
It's normally defined in the agreement when we are acquiring
Okay.
And how is, say, the founders would like to have a representative, we would like to have a representative, how can we actually find a criteria, a mechanism to elect board members so that each party feel that they have been part of the process?
I am sure you know that there are a lot of myths out there. I talked about them in the beginning about, greedy, cold private equity companies coming out there who are only interested in money and not people. So when you hear this, what are your thoughts, and how would you describe Verdane's approach as a new owner of the business?
As I said, that we would like to be, so say, the preferred growth partner. We know that how we behave in each of our companies will be quite transparent for their relations, their connections. You have LinkedIn. It's quite easy to actually make your own research. So we really try to behave in a way which we think is the right way to behave. And how we
you live by your values.
Live by our values, I think is extremely important, because if we were to oversell ourselves during DD, that will lead to a disappointment of the former owners, the management team. So we really would like to get alignment and get a transparency.
Do you think that you're interfering a lot with running the business, the continued running of the company, or how does that work? I mean, you have great experts, but do you then come in with your experts uninvited or more invited?
I think it goes without saying it's the latter. I think our goal is to interfere as little as possible. What we do offer is access to what we call an ecosystem of portfolio companies for peer-to-peer learning. So our data team helps you benchmark across various levels of the organization versus our historical and existing portfolio. And our Elevate team supports you on key growth initiatives agreed in the DD phase. We also offer a very active CXO events and community events. You know that you have been part of, so say,
Yes.
Verdane CEO days. And these are, of course, bringing up interesting topics. But at the end of the day is for you as a CEO, which can be quite lonely sometimes, to really interact with other founders, other CEOs, to really, perhaps, I would be interesting to point that back to you, how you felt being part of, so say, a larger community and how that actually helped.
Yeah,
you.
no, I think that you're right. It can be pretty lonely, and I think that it was really great to have peers to compare notes with, and share ideas and ways how to grow the company with, because they are all more or less in the same situation, or at least they were when they got acquired. And I thought it was, actually, I'm still talking to some of those today, even though now, unfortunately, I'm not part of your portfolio anymore. But I think that created a great network, and it's also something that can develop me as a CEO personally. So it is not only for the sake of Verdane or their companies, but it's actually also for my personal development. So I thought that was very, very useful. For how long are you in average? We were talking about the funds were 10 years or longer, but are you the owner of a company for 10 years, or what's your average ownership period?
I mean, first of all, it varies, but the average holding period is 5 years. And I mean, the general answer would be, when are you not an owner? I think until we've been able to deliver on the agreed growth plan and the company is the place where it would benefit from a new ownership. In practice, what that means varies from company to company, but somewhere between 3 to 5 years would probably be, I think, the average.
So can you mention, I know you can't mention names or company names or be very specific in terms of which companies we're talking about, but can you tell us in general terms, what is a success and sort of the best deals that you can do? Is it just money? I know that PEs are actually put into the world to make money, but are there other parameters where you measure your success on?
Yes, definitely. I mean, first of all, we always define where we want the company to be at the start of our engagement with the new.
Size-wise, geography, how?
Both actually. So the exact ambitions differs from company to company, but a classic example includes going from a national or like a regional champion to be like a European or a global champion with a significant uptick of revenues, either from new geographies, probably diversified revenue streams, and a high degree of resilience and improved margins.
How do you do that? How do you help create resilience, and how do you help create better margins?
I think it's first of all to see where can we make this company more efficient, and then it goes back that we have been doing these type of investments for a long time. So we can actually see, are the company having an efficient onboarding process for new customers? Are they having an efficient R&D development? Have they been working with pricing in an efficient manner? Are they really understanding what kind of value they are bringing to the table? Would it be possible to either change that to make it even more efficient, and so on? So I think, first of all, I think we try to really make, I mean, success is one of course, that we are delivering a return back to our investors. But it's of course, can we make this company improving to be a better company once that company is bought compared to when we invested into the company?
I think that's a very important thing, at least to highlight to the owners out there who are thinking about selling their company, that this could be actually a pretty interesting journey to be part of, that it is something that not only will develop the company that you're CEO of, but you as a person would also grow as much as your company. At least that's my experience here. So that it was a very interesting time, and I think that I personally learned more on those 3.5 years or what it was with Verdane than I had done from the previous 20 years. So it was very exciting to actually grow with the company and also personally. Last question here before we end the interview. I think there would be CEOs out there who would be keen to know if they are actually also involved in selling the company second time around. So are you engaging into a dialogue with the CEO when you want to sell the company again? Or is it something that you alone will decide from the Verdane side?
No, it's very much done together. I think first of all, we also need to understand what is the ambition of the CEO today. Would he or she want to make this as another 5 to 10 years journey or not? So for instance, if it's quite clear that the CEO feels that this is a fantastic journey, which I've been upon, but I'm not sure that I would be the best suitable for the next journey, then we need to identify the substitute or replacement actually before we are selling a company.
So you have a pretty open discussion with
pretty open
CEO.
discussion, because you can't actually position a company to be bought if the existing CEO is not committing to be part of the future journey.
At least it's nice to know up front, because if you need to prepare the material and know whom to approach, you need to know what sort of buyer you need to approach. If it's a buyer who's actually very keen to have the CEO on board and not perhaps an industrial buyer, they all have their own CEO, so maybe it's not that necessary. But if you want to pass it on to another PE or a financial buyer, it's pretty important that they are...
I think you need to be open, have that discussion, because it can be also that you have an industrial buyer, but without any local presence in this region, so they actually need to have the CEO on the continued journey.
True.
So I think, first of all, we need to prepare the CEO. Are you willing to work for the next owner, at least for a 2 to 3 year period? Yes or no? If it's a yes, then I think we can start working on that. If it's more a question mark or a no, we need to think about, do we have any second in command? Do we have any replacement that actually can fulfill the existing shoes of the CEO if and when needed?
And I assume you start this dialogue in pretty, a few years or one at least before you start the process.
I would say
if you need to have someone else to step in.
The earlier the better, because first of all, if you are going to replace a CEO, which I think is one of the most trickiest thing you can do, especially in a founder-led business, and that needs to take time, and the founder and we as an owner need to be aligned on the profile and the timing, and it needs to be supported by both parties. Otherwise, the new CEO will have a very tough time if, for instance, only you as a founder would support him, or i.e. only we as the investor.
Yeah, makes sense. Henrik, thank you so much for educating us about the boundaries between seed, venture capital, and private equity. And I would like to wish you good luck selecting your next partners and you are a great owner. I can sign up for that at least. And I enjoyed the journey with Verdane, and I really hope for many of our listeners out there that they can actually see what I have seen. So thank you so much for participating.
Thank you for having me here. And as I'm speaking for on the entire Verdane team, that we were super happy that you actually decided to pick Verdane as a partner. And as you mentioned, although we didn't pay the highest price on the table, but I'm happy to hear that you are happy what the value we brought to you and the company.
Certainly were. Thank you so much.
Thank you.
Tusind tak, fordi du lyttede med. Og vil du sende dit spørgsmål vedrørende salgsproces og lignende til panelet, så følg linket i show notes og udfyld den kort formular. Igen, tusind tak, fordi du lyttede med. Mit navn er Bettina, og vi høres ved.